Today we're diving into a hot topic for anyone tracking Singapore's investment scene. Are Singapore REITs, S-REITs, finally at a rewarding entry point, with prices hovering near historical lows and yields looking juicy? The big question is, will fortune really reward the brave this year? Let's break down what's happening, why it matters, and what it could mean for your investment strategy. I will take a reference from this research report, Fortune Rewards the Brave, Singapore REITs, by DBS Group Research, as the foundation piece for this video. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, retirement planning, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 850,000 reads and 53,000 likes. I've produced over 800 videos with more than 350,000 watch hours as of February 2025. I also focus on regional and global economic trends. Let's start with the headlines. S-REITs have taken a beating over the past year, mainly because of high interest rates, global uncertainty, and worries about a slowdown. But here's the twist. S-REITs are now trading at a price-to-book ratio of about 0.8 times. That's roughly a 20% discount to their long-term average, and it's a level we've only seen during major crises like the global financial crisis or the COVID-19 pandemic. Historically, investors who bought in at these levels have enjoyed positive returns a year later. So, why are S-REITs so beaten down? It's a mix of things. First, rising interest rates over the past 2 years have pushed up borrowing costs for REITs, which eats into their profits and reduces the distributions investors receive. Next, global uncertainty. Think trade wars, US tariffs, and fears of recession has made investors extra cautious. Many are sitting on the sidelines waiting for clearer signals. But here's where things get interesting for Singaporeans. The tide might be turning. Analysts expect interest rates to fall in 2025, with the US Federal Reserve likely to cut rates up to 3 times this year. If that happens, S-REITs will benefit from lower borrowing costs, which should boost their distribution per unit, or DPU. This is especially good news for REITs with a higher portion of floating rate debt, as their interest payments will drop more quickly. Now, let's talk about yields. At current prices, S-REITs are offering forward yields of about 6.7%. That's a solid spread of around 4% above the Singapore 10-year government bond yield. For context, this is one of the most attractive risk-reward profiles we've seen in years. Even if property values fall by another 15%, which is a pretty harsh scenario, most S-REITs would still stay within the monetary authority of Singapore's gearing limits. The sector has already shown resilience, thanks to past recapitalizations and smart asset sales. So which sectors look best? Most analysts are positioning conservatively. Retail REITs first, then industrial, followed by office and hotels. Retail REITs, especially those focused on suburban malls, have shown steady occupancy and positive rental reversions. Industrial REITs, think logistics and data centers, are riding on strong demand from e-commerce and digitalization. Office REITs are a bit more mixed, but with new supply slowing down, there's potential for rents to stabilize or even rise. For value hunters, some names stand out. MapleTree Pan-Asia Commercial Trust, MP808, Far East Hospitality Trust, FEAHT, Sasor and Fraser's Logistics and Commercial Trust, FLCT, are highlighted as having mispriced risk. These REITs have already priced in a lot of bad news, so if conditions improve, they could deliver strong returns. Let's zoom out for a second. Why do S-REITs matter so much for Singapore investors? For one, they're a key part of many CPF investment schemes and retirement portfolios. Their steady income and exposure to real estate make them popular with both young investors and retirees. Plus, with Singapore's economy expected to grow around 3% this year, and the government pushing for more liquidity in local equities, the environment is set for a recovery, if you can stomach a bit of short-term volatility. Of course, there are risks. If the global economy slows more than expected, or if consumer sentiment weakens, especially in retail, there could be further pressure on earnings. And while office and hotel REITs look cheap, they're also more exposed to swings in demand. It's crucial to focus on REITs with strong sponsors, healthy balance sheets, and assets in resilient sectors. So what's the bottom line? History tells us that when S-REITs trade at these kinds of discounts, patient investors are often rewarded. With yields near multi-year highs and the prospect of lower interest rates ahead, 2025 could be a turning point. But as always, do your homework, diversify, and don't rush in blindly. Sometimes, fortune really does reward the brave, but only those who are prepared. If you found this analysis useful, hit subscribe and turn on notifications for more insights on Singapore's investment landscape. Drop your questions or thoughts in the comments. Do you think S-REITs are a buy now? Or are you waiting for more signs of recovery? Until next time, stay curious and invest smart.